Hello everyone. Today our team comprising of myself, Pushkar and Ankit are going to present our final year major project on adaptive and multi-class portfolio optimization system. Suppose I have 10 lakh rupees which I want to invest. Since I am young and have the ability to take high risk, I will invest 6 lakhs in stocks and 4 lakhs in bonds. This is a portfolio of multiple assets. Next slide. Next slide. Managing this portfolio is the process of selecting, monitoring, and adjusting a portfolio of assets to achieve investment specific objectives. It basically involves balancing risk and returns, diversifying the portfolios, and making adjustments based on market conditions and investor goals. Portfolio optimization is a process of optimizing portfolio in such a way that returns are maximized and risks are minimized. This involves using mathematical models to analyze the performance of different portfolios and select the one that meets the investor's objective. Next slide. After analyzing all the research papers on existing models, we have observed following gaps, which are absence of multi-class asset allocation while portfolio construction and portfolio optimization, absence of consideration of new trends such as company results or uncertain conditions situations like COVID pandemic, and lack of optimization strategy in hedging. Next slide. So we have defined the problem as to develop a model that constructs customized hedged portfolios integrating multiple asset classes based on sentiment score. Next slide. From here, Pushkar will continue with the APS model.
Now moving on to the system architecture of a model. A system architecture consists of two main components. One is the portfolio construction and second is the portfolio optimization. For portfolio construction, we take the input data of the user such as the age, the annual income, the investment amount and the sentiment score, which is the risk taking score, which is calculated by the answers of quiz of multiple questions. Uh, Providing that data to linear programming model and adding multiple constraints from the Federal Reserve data, we try to maximize the equation which gives the allocation of stocks, bonds, and commodities such that it will return maximum profit with minimum risk. Then the created portfolio is evaluated using the alpha model, which is basically just a comparison of the index returns and a portfolio returns. The risk model is used to investigate the risk taking to investigate the risk factor of the asset and try to minimize it. The second part consists of portfolio optimization, which has two components: Monte Carlo and hedging strategies. So Monte Carlo is basically used to test out the model on various random simulations. So we created simulations of 10,000 portfolios and ran our APS model. The hedging strategies is used to compensate the loss of the portfolio. Next slide. Now moving in detail of the modules in portfolio creation, the linear programming model, as explained, maximizes the equation which gives us the answer of the allocation, like the percentage allocation of stocks, percentage allocation of bonds, and percentage allocation of commodities. Next slide. So this is, as mentioned, the input data, the user's age, user's annual income, the amount that user wants to invest initially, and the risk tolerance level. Next. The output data of the linear programming model is such that the allocation of the bonds, commodities, and stocks are given. Also, the total expected returns are calculated by the current returns. Next. The alpha model is used to generate the excess risk adjusted returns, which is the portfolio return minus the benchmark returns. Next. The risk model is used to evaluate the risk of the financial asset, which is calculated by the formula given in the slide. Next. Now Ankit will continue modules in portfolio optimization.
So, as Pushkar explained about the creation of the portfolio, so the real question arises after the creation of the portfolio, how to maximize the profit in long term. For that, the second majority part is portfolio optimization. For portfolio optimization, the two main techniques we have implemented. First is Monte Carlo simulation, and second is hedging strategies. So in Monte Carlo simulation, we have tested randomly created 10,000 portfolios and analyze the relationship between the risk and the volatility factor of each portfolio. So here we this is the efficient frontier of generated 10,000 portfolios. So here we can say the yellowest portfolio, it is having the lowest risk and the highest return. So we have used that portfolio's weight into the consideration of the uh, optimizing the portfolios. So the second method is hedging strategies. So what is hedging? Hedging is nothing but risk management strategy, which is um, maximize the return based on like taking a opposite position of the portfolio or any asset class. So from this graph, you can see like at the suppose in 16 on the 16th of the August, a model predicted that the in the next few days, a few weeks, the market will fall by 15 to 20%. So to compensate those losses in the portfolio, w- we have like that this model will create an alert and it will suggest uh, x amount of hedging quantity to buy so that we can compensate the losses and maximize our profit. So this is the hedging formula. Q asset uh, gives us the quantity, how much quantity to buy against the portfolio of the asset, and the P asset is the portfolio amount of the asset. HR is between 0 to 1. It is a hedging ratio. As asset is strike price of that put option, um, and the delta is the variation of the change of variation of the price with respect to of that that asset price in based on the expiry. So this is the hedging formula. So coming on to the data pipeline, to make our like model robust, we have tapped into the various data sources. So first is the Federal Reserve data, where we get a sample of the data where the risk taking ability of the user and their like their income, age, and annual initial investment, etc. So, but the main thing we have calculated is the psychology score, which is based on the money psychology of the user. So for that, we have asked 5 questions. So one of the question is like how user perceiving to take risks. So for example, if the what will the user choose to take 5 month like 5 lakhs per month, guaranteed 5 lakh per month for next 5 years, or there is a 50 second option is there is a 50% chance of getting 10 crore instantly. So based on that this type of psychology money question, we have uh, derived a psychology score which we are putting and training the model on. So and for the real time data, we have used Yahoo Finance API, and for sentiment of the stocks, we have used news organization API. So this is the overall data pipeline. So now Pushkar will continue with the result analysis.
Now we deduce two hypotheses from our analysis. The first hypothesis states that the difference between the Sharpe ratio of the index return and the portfolio returns will be around 15%. When we generated 20 portfolios and plotted the graph against it. And next slide. So this is the form. This is the code to generate the 20 random portfolios using the linear programming function. Next slide. Yeah, so as we can see in the graph, the difference between the index return and the portfolio returns after using our APS model, the upper limit is around 14% or 15% at max. So we rejected the null hypothesis and accepted the alternate hypothesis. Next slide. So moving on to a second hypothesis, when we included sentiment score in our APS model, the difference between the returns with sentiment and without sentiments were around 17%, which we checked by plotting the graph of the returns with without sentiments and with sentiments. Next slide. As we can see in this graph in the result analysis, most of the returns are negative, which is what we wanted. The returns with sentiment are greater than returns without sentiment, and the upper limit is 17, which is 17%. Next slide. So this is the demo of our financial portfolio creator. We take input users age, income, and investment amount. Next slide. So these are the psychological questions which are asked to calculate the psychological score. So based on the each option, we have deduced a formula which gives a sentiment score or a psychology score between 0 to 100, and we can classify the score as per low, medium, and high. Next slide. This is the output of a financial portfolio creator. Basically, the allocation percentage of the assets, what it should look like, the percentage allocated to stocks, bonds, and commodities, and the top stocks to invest and the top commodity to invest in, such that the returns are maximum. Now Sonal will take on for the conclusion.
So it can be concluded that the APS model gives multi-asset allocation in various asset classes like stocks, bonds, commodities, etc. The model has a novel hedging strategy, which is the main novelty of a project. Then the model is integrated with sentiment score of new trends while rebalancing the portfolio. Next slide. So we can improve the model in future by integrating it with stock price sentiment based on quarterly results of the company and integrate simple moving average to identify uncertainty of the market. Thank you.